you want to become a millionaire? Do you want to quit your job? This is a video for you! Not actually. I'm tired of these guys online selling you courses on how to become a millionaire. They are nothing but lies. Do you think that with a 2-hour long video or a tiny little book you're going to be a millionaire to the next day? Obviously not. So what I do for a living is trading. If you're into trading, I'm going to be teaching in a series of videos how I trade, basically following the smart money. I don't trade following patterns, double top, trend line, harmonic, Fibonacci retracement, all that stuff. Price doesn't move because that exists. Price moves because these entities, the smart money, is gathering, accumulating, and distributing orders. Why? In order to make profit, to hedge, or whatever they are doing, but they have the power to control price. We need to detect that manipulation and try to play with them. So if you're into this, follow me because I'm going to be releasing a lot of valuable videos on how to trade like a pro. Day 2 of teaching you how to trade like a pro. When you began your trading journey, you probably open a new tab and you search for trading patterns, because there is nothing as fun as looking at the chart and trying to find these patterns. These patterns are nothing else than a representation of what you shouldn't be doing. You probably looked at a bullish flag, double top, triple bottom, trend lines, MACD, RSI, EMA, everything you can imagine. What is the problem? The problem with these patterns is the fact that they can be seen by everyone. And we have a tendency of trying to give sense to present price action based on past price action, aka patterns. And as I mentioned on my previous video, smart money doesn't trade like we do. They need liquidity, and the liquidity will be in price levels where less informed traders see a pattern. They will open trades and place stop losses and take profit based on those patterns. So that's where smart money will move price to, in order to trigger and capture that liquidity. Day 3 of teaching you how to trade like a pro. In this case, we're going to compare the point of view of a less informed trader against a smart money trader. What do they see in the same chart? In this example, we have a strong reaction here, a long wick. We can say that this is a double bottom. We can even say that this is a trend line. So this trader is going to be looking for a longing opportunity. But what does a smart money trader see? Well, they see the same. They see that there is a possibility of this being a pattern, meaning that below these lows, there are going to be stop losses from people trying to long this level. Even when price comes back down here, they see that there are going to be pending orders, buy limits from these people. So what they're going to do is they're going to short here, looking for that liquidity, playing aligned with smart money, not against them. And what happens next? You guessed right. Day 4 of teaching you how to trade like a pro. First, you need to understand the market structure. What is the market structure? It's a graphical way to understand what is smart money doing. Are they buying or are they selling, and from where? If we look at this, we can quickly identify that price is building higher highs, higher lows, higher highs, higher lows, and higher highs. What is it telling us? That whenever price hits a discounted level, basically a cheaper price, smart money is going to be buying. When price hits a premium level, basically a more expensive price, creating a higher high compared to the previous high, they are going to be selling or distributing orders. So if we can identify this on a real chart, you will see exactly what I'm talking about. Here we have an easy example of how to identify a bullish trend. In this case, we can have a high, a higher low, then we have a higher high, higher low, then higher high. This can change, especially when we talk about different time frames to look at the chart. So we are going to talk about this on coming videos. Day 5 of teaching you how to trade like a pro. Let's talk about fractality. Fractal means that anything can be seen on different time frames. So if we look at a bullish trend on the 5-minute chart, for example, and then we switch to a 1-hour chart, this 5-minute uptrend is going to be probably inside of a bigger downtrend or uptrend on a higher time frame. So in this example, the red line is going to represent the 5-minute chart and the green one is going to represent the 1-hour chart. So as you can see, the 1 hour is bearish, making lower lows and lower highs, but the 5-minute chart is bullish, and at the same time it switches to bearish when they follow the higher time frame order flow. Looking at the real example here on EURUSD, the 1-minute chart, we can identify 2 different degrees of structure. Here we have a downtrend, a series of lower lows and lower highs, and this downtrend is inside of a bigger downtrend from a higher degree of structure, which is represented by the red one. So in this case, we have 2 different degrees of structure in the same time frame. Day 6 of teaching you how to trade like a pro. So we have 2 market states. When price is trending, we are making higher highs and higher lows, or we are making lower lows and lower highs, basically a bullish or a bearish trend. And inside of this trend, we can say that the move that goes in direction of the trend is going to be an impulsive move. The move that goes in the opposite direction of the trend is going to be a retracement. Ideally, to help our account, we want to take trades aligned with the trend, basically impulsive moves. Why? Because they tend to move faster with little to no drawdown. The other type of market structure is when price is consolidating. Usually after an impulsive move comes a consolidation, which is a narrow range when price is not going anywhere and smart money is capturing liquidity on the buy side, on the highs, and capturing liquidity on the sell side. Only after they finish accumulating orders, we are going to see another impulsive move. Usually the retracement will look like this. In the next video, we're going to analyze some specific examples about this. Day 6, part 2 of teaching you how to trade like a pro. In this case, we are looking at the daily chart on EURUSD and we can clearly identify a bullish trend that has been going on since March 2020. In this trend, we can quickly identify the impulsive waves, the ones who are going in favor of the trend, and the retracement, the ones who are against the trend. And inside of these retracements, we can also see the consolidation phase, that boring part where price is not doing anything, it's going back and forward in a narrow range. Usually this is when less informed traders get stopped very often, basically what Wyckoff refers to as weak hands. So smart money is going to be stop hunting highs and lows, grabbing liquidity on the buy side and on the sell side liquidity until they are ready to push and displace price higher in this case. And as you can see, this is happening every time price makes a new higher high, we see a consolidation phase. If you guys are loving this content, don't forget to like and subscribe so you don't miss any video. How to know what is the intention of the smart money? With the break of market structure. When we are on an uptrend, for example, we know that price is pushing higher, accumulating orders from cheaper prices. But when price breaks the last high low that was produced, it's telling us that smart money does not longer care anymore about the longs that they accumulated down here. Why wouldn't they care anymore about these longs? Because now the intention is to go lower. This break of market structure by itself is only one pattern, so it needs to be mixed with other specific conditions. To look at an example, we can see that price has been pushing higher on EURUSD, creating an uptrend, higher highs, high lows, higher highs, high lows, and at one moment we have a break of market structure. Price fails to respect the last high low, which in this case was this point here, and makes a lower low. Ever since this happened, price shift into now a downtrend and continue making lower lows and lower highs. Day 8 of teaching you how to trade like a pro. So every time price breaks the market structure, there is a range that is created. This range is going to be from the last high and the last low before the break of market structure. As you can see in this example, this was a break, so price is now trapped between these two price tags. Inside of this range, smart money is going to be retracing and accumulating orders again to push higher if they want to continue the uptrend. So how do we know where price is likely going to stop? If we grab a Fibonacci tool and we divide this into two parts, we have the 50%, which is equilibrium, below 50% is discount, and above 50% is premium. So price most of the time will come to a discount level, accumulate orders and push higher again. Day 9 of teaching you how to trade like a pro. So when price is retracing from an impulse move, there are many ways this retracement can look like. I told you about the consolidation where price is simply going back and forward until it continues going higher, or there is what is called a simple retracement when price makes one simple move and then continuation higher, or a complex pullback when price makes a series of swings inside of the range, usually respecting this low and this high, the range itself, and after they finish accumulating orders, they push higher. This is very important to know, since every time we have a break of market structure, you will be expecting one of these options and you will consider any of them as possible. Day number 10. Now we're going to look how to apply these different ranges, applying the multi-timeframe structures. So again, coming back to this very same example, EURUSD, we are currently on an uptrend. This uptrend can be seen also on the weekly chart, but we're going to mark it like this. You can see that the last high low was down here. That means that the weekly range is going to be from this low to this high. And as you can see, price is producing a complex pullback. So inside of this complex pullback, we are going to have lower time frames, uptrends and downtrends. And as we can appreciate here, the last trend is a downtrend inside of the daily chart. We have been making lower lows, lower highs, lower lows, lower highs, lower lows, and the last range is from this high to this low. So now price is trapped between the bigger range, the weekly, from this high to this low, and the lower time frame, daily range, from this high to this low. If you continue going to lower and lower time frame, you will continue finding different trends on different time frames.